on.
I do need my camera on eventually. We're open for business. Ta-da. Let's do that. All right, open for business. And then let's do this while I've got you here. Tony, let's go to the slideshow. We got to go to slide number 1 from the beginning. And then we have to hit escape for the full screen. And then I think I got to do the share, which will do that and that. Hello, everybody. You get to watch us get set up here. And from the beginning, ta-da. And Tony, that looks good?
Yep, looks
okay,
good.
Perfect. And I just got to open up the chat. Tony, you're not sticking around for this one, are you?
I don't have to, I guess. I didn't think about it.
No, you don't, because now I am fully in charge. So we are good to go. So, all right.
All right.
Terrific. So we'll get, yeah, Tony, thank you very much. Enjoy your evening. And if I panic, I will call you.
Right, sounds good.
So
have a good
there
one.
you go. Thank you. So for everybody that's joined us, for everybody that's joined us, oh, look at this. I'm starting to skip slides already. So there you go. For everybody that's joined us here today, my name is Rich Kimball, and you guys are here for the home buying presentation. So welcome, and I'm going to give it a minute or two to get everybody else in. We had a couple different registrants or some other people. If I can, we have a chat box, which is how we're going to communicate. And if I can get from whoever's here, because I can't see you guys, let me know in the chat box things that you want, that you got questions about, things that you came here to learn. And if we don't cover it in my PowerPoint that we covered today, I'm going to make sure we cover it. So please jump into the chat box and let me know if there's anything that you want to cover. You could send it directly to me if you need to, but I want to make sure I answer all the questions. So, you know, at the end of the day, this is about you guys. So, yeah, so I want to make sure we cover everything. So this is our home buying class. We do this every month. This month it happens to be in the evening. Next month we will do it on a Saturday between 9 and 10. We try to cover everything that you're going to need to know as you're on this journey. So first of all, myself, excuse me, I've been in the mortgage business for about 30 years, worked for CrossCountry Mortgage for the last 10, and our company did about 53 billion last year. Sold loans directly to Fannie Mae, Freddie Mac, Ginnie Mae, and then we do keep many of the loans that we make, so you'll end up paying CrossCountry Mortgage as we go forward. So I've also been a licensed real estate agent. I've actually flipped homes before. I am currently a landlord and have been a landlord for a while. And we're going to talk about landlord-ishness and tenant-ish and stuff coming down the road. But that's briefly who I am. Again, if you guys can, enter any questions that you have, anything that you want to know, please put that into the chat. We want to make sure that, again, this is really for you. I know this stuff. So let's make sure we cover everything for you guys. And now let's get to the next slide. Perfect. So this is what we're going to cover: renting versus owning, the bonuses to buying. We're going to look at a plan for you. We're going to actually talk about the financial piece of it. And the home buying roadmap will just kind of walk you through the steps. Then the last thing we're going to touch on is what we call our wealth accumulator. Real estate is a big key to wealth, and renting is not. So, all right. So renting versus buying today, we're in kind of a unique market today where, actually, I want to go back a second. We're in kind of a unique market in the sense that we have lack of inventory. So that shouldn't be a big shock if you're just entering the home buying process. Lack of inventory means that we don't have enough houses available for all the people that want to buy them. So if, as you're entering this process, please know that you may be making an offer on more than one home till you get your offer accepted. And we're going to talk about some keys to getting your offer accepted. Now, also, with regards to renting, what I'm hearing now is that a lot of landlords are looking for very high credit scores and actually looking for the income on the rental application to be at least 4 times the rent. And this is actually creating a situation where, as we talk about, we're in a tight inventory market for homes, the rental market is also becoming just as tight. So it should be an encouragement for you to tough it out, have to make those offers. And my job and the professionals that you'll be with, whether it's your realtor, whether it's your lawyer, those professionals are here to make sure that we get you across the finish line happily. So let's talk about some of the bonuses to buying. So, hey, one of the things you get to do is paint the walls. So you could get crazy and do whatever you want. So one of the nice things about buying is that you can do whatever you want to your home. You can have whatever pets that you want. You don't have to get any of that stuff cleared by the landlord. Additionally, with regards to family instability, it's statistically proven that children that are in a home versus children that come from an apartment or a rental scenario, the kids that come from a house do better academically, and they actually have less disciplinary problems. So that is a proven fact. Now, pride of ownership is also really important as far as you owning the property. You call your landlord to make a repair, your landlord's probably going to make the cheapest possible repair that they can make, whether it's a toilet fixture, a new appliance, or something along those lines. You make the repair and you pay for it, you're going to get exactly what you want. So pride of ownership is really important, because in a rental situation, you're relying on the landlord. In the ownership in situation, you rely on you. Building equity and wealth is important as well. And ultimately, 90% of all millionaires either started with real estate and or still own real estate today. So the average net worth of a renter is about $4,900. The average net worth of a homeowner in the United States is about $190,000. That's a huge statistic and a fact. So if you want to build wealth, paying money into a house is much better than paying money for rent. So, all right, next thing that we want to talk about. So we have to have a plan. Really, one of the first places to start is to sit down with your mortgage professional and discuss the financing, because without the money, you can't buy the house. So the other parts of it are the emotional and mental parts of this. And there are some emotional things that we're going to cover. I'm not a therapist, but sometimes I feel like that as we go through this. So speaking of that, one of the things that we would want to talk about here is you should know your why. So maybe your why is bringing home a second dog. So that's your why. You need more space. Maybe you need a backyard because you brought another dog into the house, whatever it is. Is your family growing? Are you relocating for work? What is the reason that you're buying? You should really know that, because it was, as we mentioned before, it'll be a little bit of a challenge. Limited inventory. You'll probably offer in a couple different houses. You should really know what's important to you about this. Next, do you plan on staying in the home for a few years? So this is a really important question. If you think in the next 36 months, there's a good chance that you would have to move, let's say it's a job offer that you've been waiting for, whatever it is, if you don't think you're going to be able to stay in that house for 3 years or more, I honestly would continue renting, because it does cost a little bit of money to sell these homes. And so that's one of the other decisions that you should be thinking about. Am I going to be here at least 3 to 5 or longer years? Next, are you purchasing with a partner or somebody that you're confident sharing a commitment with? Now, in a marriage, in that relationship, purchasing with a partner, you're married, you've sworn before God, friends, and family that you're going to be together. That's one conversation. What I really want to address is friends buying homes together, siblings buying homes together, So if you're in a situation where you're buying the home with somebody else that is not your spouse by marriage, then you really should talk about what happens if we decide not to move forward. So siblings, sisters, let's say, buy a home together. One of the sisters actually starts dating a significant other. She decides that she wants to go on. What happens to the house you're in? That's a really important conversation. How you're going to handle that future scenario where the person isn't going to be there with you needs to be discussed before you buy the house. You should have a very clear plan what would happen if one of the two people that are buying this house together decides to move. All right. And how much work are you willing to put into the home? It is an important part of what you should be thinking about ahead of time. If you're handy and you like the DIY shows on the weekend and all that stuff, great. If you're not, and you don't have a relative or a friend that you can call and say, hey, I might need some help with something, if you have to pay for some of this stuff, keep that in mind that you may want to have a little bit of an emergency fund because stuff happens in a home. Stuff breaks, you'll need to fix and repair some things. And if you can't do it yourself or have friends or family that are in those trades that can help you, just be a little bit more prepared in the back of your mind that, hey, I may have to do this. A really nice option is to get a home warranty when you purchase, especially if you're not handy. So before I go any farther, any questions about home warranties, anything else we've covered, please throw that into the chat box. It would be good to have some interaction to make sure that we've got, I know that you guys are there. And number one, or number two, that I'm actually covering the things you guys want me to cover. So we're going to move on to the next slide. So now we talked about the mental part of it. We're going to talk about the financial part of it, as it were. So on the financial part of it, there's 5 areas that we're going to cover. Credit, obviously, real easy thing with credit. The higher your credit, the better your interest rates are. And the better your mortgage insurance rates could be, the better your homeowner's insurance rates. It is true that a homeowner's insurance company will pull your credit. Now, it's not a hard pull. It's a soft pull because it's really not a request for credit, but they are going to look at your credit to assess what to charge you to insure your future home. Monthly survival number, we talked about that a little bit when we talked about, hey, if you have to make the repairs, you should have an idea what your monthly survival number is, meaning is the minimum amount of money that you're going to pay on all of your bills. Is it $3,000 a month? Is it $2,000 a month? What is that minimum number? Once you know what that is, it's not a bad idea to start savings for that, even after you buy the house. We actually are going to do a class every other month moving forward for our buyers who close, which is called We Got You Into Debt, We're going to Get You Out of Debt. And we're going to cover budgeting. We're going to cover wills, life insurance, a bunch of stuff. And we actually have a budget class that we're doing every other month. So if you're interested in some of those classes, reach out to us. Once we close, we'll personally invite you to hit some of those classes. I think they're really important. It's our promise to you guys. The company has a motto, more than a mortgage. My promise to you is we are more than a mortgage. We're going to be here for you past that and help you out. Now, cash. So we're going to talk about how much money that you need down plus how much money you need for closing costs. Income. We are going to talk about income and how we as a lender look at that. And then the last thing is debt to income ratio, and we'll cover that as well. So let's talk about credit score. Just so you know, those of you who are here today, we are going to do a class on Saturday, 9 to 10 via Zoom. I'm actually going to be more of an MC, if you will. The class is going to be hosted by Jim Drusky with Illinois Credit Services. And he's going to cover everything you want to know about credit scoring, things like that. We're going to cover a little bit of it here. So what makes up your credit score? It's an important thing to know that your credit score actually isn't given to us by TransUnion, Equifax, or Experian. There is a company in the middle called FICO, or Fair Isaac. FICO is the acronym. FICO pulls the information from the 3 reports, and then they generate a score for us. What the score is the likelihood of success of that borrower. So if they look at the credit and it pairs up with credit reports they've analyzed in the past where people have paid things on time, you get a higher credit score. So they basically set these formulas or algorithms, if you will, by looking at people who defaulted and then maybe going back into their credit a year before that and start to see some patterns of things that happened before that default happened. So obviously, one of the important things is payment history. So if you're paying your bills now on time and you've never been late, it's 35% of your credit score. The next thing that people don't know as much, it's not as well known, I should say, is the amount of credit card debt you're holding versus the amount of credit limit you have. So for round numbers, if you have $1,000 credit limit and you owe $800, you are 80% advanced on that credit card. 80%, by the way, is considered very risky because you're at 80%. You don't have a lot of room left. The higher that percentage is, the lower your credit score could be potentially. Keep in mind one important thing. It's not about the dollar amount that you owe. It's about the percentage of balance versus the limit. Here's what I'm talking about. If you had $5,000 in credit card debt, but let's say you had one credit card, $5,000 balance, but the limit on it was $50,000. You're only 10% exposed, or 10% using 10% of the limit. So even though it's $5,000, which seems like a lot, it's only 10% of the limit. If you have a $300 department store card and you owe $299 on it, you are 100%, you're maxed out, essentially. You're at 99 point whatever, but you're maxed out. And so even though it's a very small number, the fact that you're maxed out versus the other person who owes a lot more, that person's going to have a way better credit score. Yeah, that's right. Way better credit score than you guys or whoever it is that has that $299 balance. So amounts owed on credit cards are important. Length of credit history. This is a really good segue, because one of the things I don't want you to hear is, oh my gosh, I got to get rid of these credit cards because they don't want me to be maxed out. No. The length of the credit card history, or the length of positive history you have, is really, really important. If you close older credit cards, it could take away from your score, because there's a long credit history that's no longer being looked at and considered in your score. So as long as the credit card company or whoever it is that you have the credit with is not charging you an annual fee, even if it's a dormant card, keep it open for as long as you can, even with the inactivity. Last 2 things that we want to talk about here is types of credit used. Things like payday loans, finance companies. Those are actually things that are triggers for future delinquency. So those could be things potentially that could hurt your score. Additionally, if all you have is an installment loan, say you got student loans and car loans, but you do not have revolving credit, because you don't have revolving credit, that will take away from your score. So ideally, you want to have an installment loan, couple credit cards, all paid on time. Last but not least is new credit. Having a barrage of brand new credit could be a trigger to somebody who is financially in despair. And that is one of the things that they've seen. When somebody unfortunately starts sinking financially, they start reaching out for the credit to try to help them, and eventually the defaults come. So not to say you can't get a new credit card, not to say you shouldn't go out and buy a car when you need a car, but if you apply for 15 credit cards, and you're trying to buy a house and you're trying to buy a car, that is the time when you could have some negative impact on your credit score. All right, credit scoring in general. Here's a basic guide. 760 and north is the best premium credit score that you can have to get the best possible rates. Yes, credit goes up to 850 as far as a score, but once you're north of 760, you're getting the best possible rates from everybody. 680 to 759, it's very good. However, as we start getting into the 600s, Fannie Mae and Freddie Mac, who provide the money to us lenders for conventional loans, they will potentially charge you more. 640 to 679, you're definitely going to be paying more. You may not be able to get a conventional loan. You may only be able to get an FHA. The lender will determine that, especially with lower down payments. And then last but not least, the 639 and lower. So credit goes down to 350. I don't see much in the threes, but I have seen some low 400s even in the last couple of weeks. But 639 below is definitely challenging. You will not qualify for majority of down payment assistance under 640. And you will definitely pay a premium for conventional or FHA financing if you could even get conventional financing, because their cutoff is 620. All right, so we covered that. Let's go to the next slide. All right, so there you go. So we do talk about the fact that, you know, you should look at your credit as soon as you can. You should get with your lender as soon as you can, because if there's anything going on with your credit that you didn't know about, you're about to find out. And often, because we are very talented in assessing credit, we look at credit reports all day, we can give you some quick advice how to add some points to your scores. So that being said, any questions on credit, please put them in the chat box. Otherwise, we are going to move on. All right. So we talked about before monthly survival number. So when you're figuring out your monthly survival number, this is a quick page that you can use as a screenshot. If you want us to send you something like this, we can reach out to us. We will send you a budget form that you could use. But the things that you should be trying to figure out is not only your rent and your car payment, your student loans, but in those other areas, maybe you want to consider some medical expenses and things like that that you have on a non-reoccurring basis. All right, that's our monthly survival number. And now we go to cash. So on your cash on hand, under the different loan programs, Fannie Mae, their minimum down is about 3%. And the maximum conventional loan on a single house is $647,200. They will allow your down payment and your closing costs to be gifted, 100% of it. With government loans, so we're going to talk about FHA, VA, and USDA. FHA requires 3.5% down. The VA and the USDA require no money down. As far as the maximum loan amount, that will vary on the USDA. VA is a little simpler. We in the Chicagoland market have closed VA loans at 1.5 million, 2 million. We've closed some very, very large VA loans. We're very unique in that regard. A lot of lenders will cap their VA loans at this 647.2 number. All right. And again, for government loans, 100% of the money can be gifted. Jumbo loans, we talk about doing jumbo loans 5% up to $1.5 million. Jumbo loans can go as high as $5 million. Jumbo loans are considered any loan on a single family where the loan itself is over the 647.2. Any loan that's over 647.2. All right. So when calculating your down payment, remember to include your closing costs. Well, that's really important. Your closing costs here in the Chicagoland area are very high relative to other parts of the country. Let's break down the closing costs. Your home inspection. Now, the majority of this is not things I, as your lender, control. Your home inspection could be anywhere from $300 to $1,000. At $1,000, you're probably talking a big house and or multiple types of inspections. Maybe you're not only doing a home inspection, but you're getting a well inspection, a septic inspection. Maybe you're checking the sewer lines out. There's a lot of things. A radon inspection can go in there. Your real estate professional, your realtor, can help you find a good home inspector. If they don't have one to provide, we do here at CrossCountry. Appraisal. Now, appraisal fee, that is a fee that you don't pay to me, the lender. You pay it to the appraisal management company. And where it could get expensive is if you're buying a multifamily home. There's a lot of different schedules and a lot of different things. As an example, in our market for a single family, appraisals run around $450 to $500. California, as an example, their appraisals to get a rush appraisal out there right now is $1,200. So again, our appraisals are on the lower end. Homeowners insurance, you will be required to prepay your homeowner's insurance for the next 12 months. That could range anywhere from $600 to $1,800, depending on the coverage, also depending on your credit. We talked about that before. Again, if you need, the quick thing about homeowners insurance is if you like your car insurance agent, that's who you're going to call to get the homeowner's insurance quote. If you do not like your car insurance agent, this is a really good time to shop for a new car insurance agent, because the car and homes are definitely cheaper to bundle together. Attorney's fee. Here in the Chicagoland market, we are an attorney, what they call an attorney state. The seller is going to have an attorney. You're kind of expected to have an attorney. I would tell you it's really, unfortunately, not optional, because the realtors in this market really aren't here to advise or help in any legal matters. They're going to defer to an attorney. If you don't, what I have found is that people who have, in very few, I'm talking like less than 2%, choose not to have to pay for an attorney, those folks typically end up needing one. What does an attorney do? So he's going to read the contract, make sure you didn't commit to anything that you shouldn't have done. If your home inspection comes back with anything that you want the seller to repair, he's going to negotiate that. If you do the final walkthrough and there's any damage on the property and you got to negotiate something in a repair, he's going to do that, he or she. But the attorney, and last but not least, they are going to be there at the closing to go through all the paperwork with you. Well worth it. All right, next, lender fees. Our fees roughly are about $15.95. They could vary, but it's about $15.95 in the lender fees. Title insurance. I do not control your title. The seller has an attorney who has a relationship with companies like Old Republic, Chicago Title, Precision Title, Fidelity Title. Those companies are who the seller is going to use to close. By the way, we're just wiring money there and sending your loan paperwork there, and you've got to go there and close. In the Chicagoland area, we're seeing on average about $3,200 in title fees to the buyer. Last but not least, we have transfer tax. Potentially in the city of Chicago, for city of Chicago transfer tax, it's $7.50 per thousand. So as an example, if you had a $100,000 home, you're going to pay an extra $750 to the city of Chicago. By the way, Hillside also has that $7.50 per thousand. Not a lot of communities have transfer stamps. Check with the realtor. They would, if they're working that market, they'll know who has transfer stamps or not. We have a great question in from Bobby. Can the buyer choose a title company? Legally, yes, you could choose the title company. It's called bifurcated. I'm gonna mess that word up, Bobby. I'm sorry. I want to say it's called bifurcated title. I don't think that sounds right. Bifurcated title, but you could do it, and your title company is going to end up representing you, and the seller's title company is going to end up representing them. Sellers' attorneys hate it. Could they refuse? Maybe. It's, if you're going to do bifurcated title, you actually need to request it early on. And the challenge that you're going to have, Bobby, is that if you're requesting your own title company and the other 8 offers on that house are not requesting their own title, they may just take that other one, because that attorney it's a pain in the rear end, unfortunately, because it's just not that common. You could choose it. I would definitely talk to your attorney ahead of time about the pros and cons to do that. You may save a little bit of money, but you also may really aggravate the seller when you do it, and it's seller's attorney. So, but you can do it. Hillside buyer pays all, and Hillside buyer pays all the transfer tax fees. So if it's $7.50, Hillside charges $7.50. So that would essentially be all the transfer tax. In the city of Chicago, it's $7.50 to the buyer, and it's another $2.50 per thousand to the seller. So if you sell a home in Chicago for $100,000, you're going to write a check for $2,500 to the city of Chicago. All right. So these are the expenses. Thank you, Bobby, for the input. I really appreciate it. So closing costs, let me going to go back real quick, guys. Closing costs. So I usually tell people prepare for $6,000 or $7,000 in closing costs. It should cover everything that you're going to need. Couple different ways to offset closing costs. One of them would potentially be, and used to be a lot more common than it is today, asking the seller to help with closing costs. So unfortunately, when there's a lot of buyers standing behind you that want to buy the same house and they don't need help from the seller for closing costs, you're likely not going to get that done. Where you may get that done is if the property's been on the market for 30 days or more, you're going to find a seller that's a little bit more negotiable, because most properties candidly are sold before 30 days is up. So that's one way to take care of it. Another way to take care of it is what they call lender credits. So we would potentially charge a higher rate of interest to you because we get paid more money, and we'll take the extra money and help you with the credits. Now, before December, we had a lot of room to provide a lot of lender credits. Since December, when the rates started going up and the market got really volatile, a lot of that extra money that they were paying us has went away. So it's a little tougher to provide ample lender credits today. We're kind of in the same situation that the sellers are. It's just tough for us to provide those closing cost credits. All right, income. So one of the things that we're going to talk about, basic income, and then some other things here. So income, remember that our job is to interpret the guidelines from Fannie Mae, Freddie Mac, and Ginnie Mae, who provides our government loans. And they have certain guidelines and rules that they're looking for. So we have to look into your paycheck stubs, your tax returns, potentially. I may not need your tax returns, but we would have to look at your paycheck stubs for sure, your W-2s for sure. What they're looking for is a consistent pay rate of history. We've had a challenge in the last 2 years because of the pandemic, where people who were maybe working an hourly job, where their hours were not necessarily guaranteed, and they had 6 months off due to the pandemic. If the pandemic, very rarely, if ever, would we be able to use the unemployment income that came from the pandemic. So, and the way the lenders have looked at it is, if 6 of your last 24 months you were unemployed due to the pandemic, I have to take 24 months of income. I'm sorry, I have to take 18 months of income. I can't use the unemployment. I have to take the 18 months of income and divide it by 24. So that's really hurt some folks. I'm super happy we're into 2022 because we're starting to put a lot of that unemployment and a lot of that stuff behind us, and it's having less and less an impact. Okay. If your income is variable, such as self-employment, such as commission, even part-time jobs or non-hourly, non-guaranteed hourly, we're going to do a 2-year average. In almost every case, we're going to require a 2-year average. All right. So now that we kind of talked about the income, and if anybody has any income questions, hit me up in the chat. Everybody's income situation is different, so I just wanted to cover some of the basics. Debt to income ratio. So this is really easy. There's 2 numbers to consider when we talk about debt to income ratio. There's the front end, and then there's the back end. The first thing that you should know is we take the gross income. I do have applicants that'll call me and they say, hey, I net $800 a week. That's great. but I need to know what you're grossing because we're qualifying you off of gross income before taxes, before 401k or medical deductions, any of that stuff. I'm qualifying you before. So we have two ratios. The front end ratio is typically called the housing ratio. The housing ratio is whatever your mortgage payment is, mortgage, principal, interest, taxes, insurance, homeowners association, whatever that total payment is divided by your income, that's your front end ratio. We gave you a clear example here, $4,000 in gross income, $1,000 mortgage payment, 25% of your gross monthly income goes towards housing expense. So the front end ratio in this example would be 25%. Now the back end ratio is your housing expense plus all of your other credit debt, student loans, car loans, installment loans, credit card payments, alimony, child support. Those things would be considered additional debt or other debt. In this example we gave, and again, we did it for round number purposes, $1,000 mortgage payment, $1,000 in the other stuff. And that 2,000 divided by 4,000 is 50%. Ultimately, the back end in this example is 50%. So there are, as far as conventional or Fannie Mae is concerned, the highest they will go on the back end is 50%. FHA will go higher than 50% for qualifying purposes. All right. So obviously keep your debt to income ratio low. And so what we talk about there is, you know, if you could put off buying a car or adding debt before you go get the house, that would be really important. Just keep in mind that, you know, if you add a car after you get the house, that's going to alter your personal budget too. So, all right, what makes up a mortgage payment? Not going to spend a lot of time on here. We've got principal, which is the amount of money that pays down the balance, interest, which is the amount of money we as a lender charge, property taxes. If your property taxes are $2,400 a year, we divide that by 12 and we collect 1/12 of it every month. We will be paying your property taxes unless you're putting down 20% or more. So part of your payment in that example I just gave would be $200 a month going towards escrows to take care of your property tax. Homeowners insurance is the same thing. If your homeowner's insurance is $1,200, we're going to divide it by 12. $100 added to your payment goes into an escrow account for you. The insurance company sends us the bill. We write the check. The last two things that could be part of your housing expense is mortgage insurance. Mortgage insurance is provided either on conventional or FHA loans, and it's really, it doesn't insure anything you own, but it does allow you to put less than 20% down. The insurance itself is actually going to the lender who is making you a loan above 80% loan to value. They have some insurance in place. If you default, they'll make a claim on that insurance. Last but not least, as far as your mortgage or housing debt, is your Homeowners Association. Obviously, that's comes into play with townhouses, condos. Some houses, like our neighborhood has, even though we're a house, I don't know, I think we have a $400 a year that goes to pay for the parkways or whatever it is. All right. So we want to talk about the home buying roadmap. And so first of all, who's who? You got your loan officer, me. So we're the money. So we are the place to start. We're the people that are going to tell you what you qualify for, how much money you're going to need, and how much your payments are. Next is, we got a question. Bobby, good deal. Who gets the money for the private mortgage insurance? So I believe I'm going to answer this question. So on private mortgage insurance or PMI, that money actually, there's companies out there like Magic, RMIC, Essent. A lot of these companies are publicly traded. And these companies, so if you have a PMI payment on your mortgage, it's going to that insurance company, going to that insurance company, going to that insurance company. If you as a buyer default to your lender and you don't make payments, that lender is going to turn around and make an insurance claim to Magic, Essence, one of those companies, and they're going to get paid out a claim based on how much money they lost, potentially. So I think I answered that. It's necessary to have an escrow account. New homeowner, can I pay homeowners insurance taxes yourself? Attila, I would say, did I say that right? Attila, I think I said that right. Basically, you have to have, if you're getting a government loan, FHA or VA, they don't care how much you're putting down. You do have to have taxes and insurance escrowed. If it's a conventional loan and you put down 20% or more, you can pay your own taxes and insurance. So, so that's the requirements in that. Great questions, guys. Thank you very much. Next, we have, as far as the important people, we got the real estate agent. We can't buy a house without a realtor. Well, you could, but you're really not getting a look at everything that's out there in the market. You need these guys. A good realtor does three things. I always say this. They do three things for you. First one's pretty easy. They're going to either list your home or show you homes to buy. The second thing they should be good at is negotiating, because there's a lot of negotiating. They may just be trying to negotiate your offer ahead of all of the other offers. But if they're a good negotiator, that's very important. The last thing is they should be mitigating your risk. So what I mean by that is they should be giving you good advice and tying you in together with a good team like us here at CrossCountry, good home inspector, a good lawyer. They are there to mitigate your risk by providing a great team to take care of you. So real estate agents are really, really important. Appraiser, that's the person that's going to determine what the value of the home is for the lender. That is not a home inspection. The appraiser, they might see some wires dangling, some obvious safety stuff that they would say something about in the appraisal report, but really their job is to do the main thing. What is the collateral to the bank worth or the mortgage company worth? That's the main thing. The second thing is the house at least safe to a certain extent? But it's not a home inspection. Really important. We'll talk about home inspection in a second. Attorney, we talked about that, what they do. I'm not going to cover that. The title company. So the title company does a couple of things, and this is really important. The title company's job is to make sure you get clean title, which means that if the seller has a mortgage, they're going to take the money you and their lender gave them, and they're going to pay off the mortgage. Make sure it's released, make sure the release is recorded with the county. They're also going to make sure all the taxes are up to date. And if there's any other weird liens, home equity loans, mechanic liens, anything else, they're going to make sure all that stuff is paid. And they're going to make sure that the seller had the right to sell you the home. One of the things you pay for is called title insurance. And that is their promise to you that you have clean title, at least until we record our mortgage, which will be the first lien on the title once you close. So they are there to also distribute all the funds. There's a closer there that will actually help balance things and cut checks and whatnot. So title companies are important. Home inspectors. So your home inspector is there to make sure that the home is safe, number one, and let you know what things you might want to plan for repairs. By the way, no home is perfect, even new construction. That stuff is not perfect. I've seen some new construction homes that have put together really, really poorly and could have used a home inspection. So homes are always going to need a little bit of something. So don't be alarmed that you have things that are listed in the home inspection. What you're really looking for is the big stuff. Like if your home inspector says, hey, that roof, even though it's not leaking today, it's got a year left on it. Roofs are very expensive. They also look at the foundation, and they may flag something for you on the foundation that they don't like. Foundation repairs are really expensive. So you want to get a home inspector to look for the big stuff and then give you an idea what the little stuff is that you might need to repair. Last but not least is the homeowner's insurance agent. Next month, we actually are going to have one of our guests is going to be a homeowner's insurance agent, but the homeowner's insurance agent is there to provide you insurance for fire, theft, all that kind of stuff. So, all right. So we talked about the who's who. Number one, meet with your lender. This is part of the roadmap. You have to start with us because if there's stuff we can fix, we have more time to fix it, whether it's a credit related item, it could be an income related item, it could be something you have to go chase down where we need some documentation and you're like, holy cow, I don't even know how I'm going to get that. So we'll help you. We have a lot of good tips on finding certain things. The sooner you meet with your lender, the better, the more prepared you're going to be. Now, let's talk about meeting with the lender. So we got a couple of things that we added in here. So you really shouldn't be looking at a house without a pre-approval letter. As a matter of fact, as noted by the soup Nazi on the bottom, is no pre-approval, no showing. Because the market is so busy, you do have listing agents that have refused to let a buyer come in the house without a proper pre-approval. So if you think you can look for a house without a pre-approval, you're grossly mistaken, and you're likely going to lose that house if it's really nice, because you're not going to be able to get something done as fast as somebody that's already pre-approved. Now, there's 3 different types of approvals. One is a pre-qualification or a pre-qual. I kind of call it a napkin app. You know, somebody calls me up and they say, hey, Rich, I'm making $60,000 a year. I've got 40 grand in the bank. I want to buy a $100,000 townhouse. My credit's perfect. Do I qualify? Sounds good to me. However, I don't have any of that information supported or backed up by anything. There isn't a good realtor out there that would accept a pre-qualification letter. They're actually laughed at. Pre-qualification, what are you doing? Where you want to be is pre-approval. Pre-approval is you've made a full application. We've pulled your credit, so we've reviewed your credit is a better way, but we've reviewed your credit. Then we actually submitted your loan to what's called automated underwriting. The automated underwriting takes all that information and it passes on judgment, lets us know if you're approved. There are some ways to get approved without automated underwriting, but for the purposes of this, we're just going to talk about automated underwriting. Once you have that automated underwriting, every lender out there says, here you go, you're approved. That's been pretty standard in the industry for a long, long time. What we've been doing is actually one more step. About 5 years ago, CrossCountry was the first company to bring this to market, where we fully underwrote a pre-approval. So what does that mean? So once we have you pre-approved, we're going to ask you to provide us the documentation that supports the things that you gave us verbally or you entered in the application. These are the same pieces of paper that I'm going to need once you guys go to contract. So I'm going to get paycheck stubs, bank statements, tax returns if I need them. I don't always need them. But paycheck stubs, bank statements for sure. Any other things like divorce decrees or anything else out there we need, we'll gather that information up. We're going to give that to a loan processor. They're going to do all the due diligence, just like you were under contract. They're going to do all the due diligence and they're going to pass it on to an underwriter. They're going to clear the conditions. And then the approval that I'm going to give to you is subject only to title and appraisal. If you want the best advantage when you're in a multiple offer situation, the best advantage is to be fully underwritten. And what I tell the listing agent that I hope he passes on or she passes on to the seller is that I can close that loan in 14 days or less because I don't have anything to do but appraise it and wait for title. That's the best situation. So, all right. So pre-approval positives, we talked about this, determining your budget, avoiding setbacks. We've kind of covered a lot of this stuff here. Things I would typically need: paycheck stubs for the last 30 days, tax returns, if applicable. So I need W-2s for sure. I don't always need tax returns. Really only going to need tax returns if there's self-employment income or rental property. Otherwise, we're thrilled with W-2s. And asset statements, we need the last 2 months asset statements, photo ID, and then of course, we'll do the credit check. Now, step 2 is to find a home. You want to basically talk to your real estate professional. You want to let them know exactly what you're looking for. You want to let them know, we talk about what your agent can help you with. There's a mention here about talking about crime rates. They can point you to websites. They are not really allowed to say, hey, don't move there. That's a bad neighborhood. It's illegal for them to say that. What they can do is say, hey, If you want to know more about the neighborhood, I have some great websites. Oh, I'm sorry, we're getting a call. All right, sorry about that. So what you can do is you can say, hey, I've got some great websites where you could check out the school ratings, you could check out the crime ratings. They can send you to some of those places. So once you find your dream home, you're going to make an offer, work with the agent to put the best offer out there possible. And let's see here. Next, after that, once your offer is accepted, the minute it gets accepted by the seller, you want to contact your lender. We have had situations in the past where somebody had an offer accepted 2 weeks ago and they never told us. And we just lost 2 weeks to work on the mortgage. So as soon as the seller agrees to your offer, please let your lender know so we can begin our due diligence, especially if we don't have you fully underwritten before you make that offer. All right. Home buying do's and don'ts. This is important stuff. Once we take your application and we provide you the pre-approval or the full approval, these are the things that you need to do. If you have any changes in compensation, let's say you take a promotion, but it alters your income, you need to let us know. You take a new job, you need to let us know. Can you change jobs in this process? Yes, but there's certain rules and guidelines that we have to abide by. Also, please continue to make your bills payment on time. I hate to say this, but it is true. We have had situations where somebody stopped making a payment on something because they redirected the money for something else and it messed up their credit. Our credit report's typically good on a loan for 90 to 120 days, and then I got to pull a new credit report. Also, if you're moving money around, keep a paper trail. Any money that moves around in your account larger than a paycheck stub is going to get questions. So if you've got a side hustle or you're doing some day trading, whatever it is, you got cash that comes in, it can be problematic. I would tell you to call your lender and say, hey, how do I handle this situation? If you're closing accounts because let's say you're coming from Southern Illinois to Northern Illinois, and you decide to close all your accounts and open up new accounts, please notify your lender immediately. I don't want to be in a situation where I send a verification of deposit to Southern Illinois Bank and you've closed up your accounts. It'll create a little bit of chaos for us. Any changes in your finances are important to know. And if you're planning to travel, and we've had situations, the perfect house sometimes comes at the worst time, which is you had a 2-week vacation planned, but 5 days before you found the perfect house. If you're not going to be available and around, we kind of need to know that. That's going to help us from a communication standpoint. Don't quit your job. That seems kind of obvious. We will verify, and we are required to verify your employment the day before or the day of your closing. So don't think you're going to kind of like change jobs and I won't tell the lender, sorry. I have to do that to have loans that I could sell to Fannie Mae, Freddie Mac, or get insured by FHA or VA. Don't co-sign for anybody. Co-signing, I would recommend never co-signing for anybody, period. It tends not to turn out well. Also, if you transition from being a W-2 employee to, hey, I have an opportunity now to become self-employed, you may have taken your opportunity to buy a house away and may have moved it 24 months down the road. So again, for self-employment, I need a 2-year history. So do not decide to become self-employed. Applying for new credit cards, closing out credit cards, we kind of talked about that. Maxing out credit cards, not necessarily a good thing. We will, by the way, and we are required to check your credit for new inquiries right before you close. So if you went out and bought a card, didn't tell your lender, you face the possibility of not being able to close on your house. So you definitely want to, I'm not saying you can't, let your lender know. It's really important. All right. So we get the file in, we're going to put it in underwriting, kind of walks through the process. We're going to order the appraisal. We're going to get you to closing, time to celebrate. When you go to closing, definitely want to be a little bit prepared. You have wire transfer, cashier's check, photo ID. It's kind of covered in the slide. Really, really, really important. If you get wire instructions via email, You want to immediately pick up the phone, call your attorney, and verify those wire instructions. Wire fraud is very commonplace. My brother and sister-in-law bought a house last year. Some hacker saw the emails going from the title company to my brother and sister-in-law. They grabbed one of the emails, recreated it with their own wire instructions, and sent it to my sister-in-law. She is very smart and she caught it. And she caught it, called the attorney and said, hey, something doesn't look right. Can you verify this? And in fact, we did determine that somewhere in Eastern Europe, somebody had grabbed that, and that's where they found the ISP, whatever. But the point of the matter is, if you get wire instructions, call and verbally verify those instructions with your attorney specifically. All right. This is the Q&A part. So that's kind of our wrap. Please keep in mind this Saturday, we have a class from 9 to 10, all about credit, everything you need to know. Reach out to me if you've got some questions on there. Also, we will do another home buying class. Let me take a look at my calendar. That's going to be April 23rd. That's our next home buying class. So if you know of somebody that would benefit from this information, Saturday, April 23rd from 9 to 10, we'll do Zoom, same presentation. This Saturday, we've got our everything you want to know about credit class. We really appreciate you guys being here. We hope you learned a lot. We would love the opportunity to actually be your lender. If you've got any other questions, please ask. Otherwise, I'm going to let everybody get on with their night. And if you've made the decision to buy, I will say this, congratulations. It is the best thing that you could do for yourself and your family financially. Guys, have a great one. Attila, thank you very much. Bobby, thank you very much for the comments. Appreciate you guys. And have a great one. Bye-bye.